Hello everyone. Today we'll study IAS 2 Inventories. This session will cover comprehensively IAS 2, but it will be a quick revision of IAS 2. I will upload this PDF also along with the video. So first of all, what is the scope of this IAS? It covers all types of inventories except financial instruments. Financial instruments which are covered by IAS 32 and IFRS 9. We will study this IAS and IFRS later. Then biological assets till the point of harvest, that is which is covered by IAS 41 agriculture. Now till the point of harvest, but what will happen after the point of harvest, that we will see in this lecture only. Then it will cover definition. Definition basically what is inventory. Definition of inventory we will see. Then we will see measurement. Initial measurement at the time of the purchase of inventory, or you can say at the time of manufacture of inventory, and the subsequent measurement, that is at the balance sheet date. This will be at the balance sheet date. Then in what situations we will recognize this inventory as an expense? And then what are the disclosure requirements as per this standard? And then example and journal entries. These we will cover in next session. Today we will cover the conceptual part of this. First of all, what is inventory? Inventory is an asset which is held for sale in the ordinary course of business. Means this is a manufactured product already, or you have purchased if you are a trading company. So it is called finished goods. And it includes the thing which is in the process of production for such sale. Means still processing is happening, it's not yet completed, it's not yet finished. So this is WIP. And in the form of material or supplies to be consumed in the production, means the thing that you are using in the production, means raw material. So first of all it's raw material, then your process is going on and it's still in the process, it's WIP, and then it's finished goods. All of these things will be included in definition of inventory. At the end of balance sheet date, suppose you have raw material costing rupees 10, then you have WIP, whatever the cost is incurred till date, including the raw material on this WIP is say 50, and you have finished goods valued at cost. All these are at cost. Profit margin is not yet included in this. Suppose this is my 100 rupees, so total 160 will be the inventory at a balance sheet date. But again we will see how we'll measure it. It can be on the basis of cost or NRV, whichever is lower. We will see it. Now we'll go to measurement. Initial measurement, cost of inventory. What will it include? It includes cost of purchase, cost of conversion, and other cost. Cost of purchase. Suppose you are purchasing the raw material, or even if you are a trading company and purchasing the full complete finished good, then it will include purchase price minus any trade discount. Only trade discount will get deducted, not cash discount. Trade discount is what? The discount which you will get when you are buying in bulk. And cash discount is that when you are making the payment as per before the terms of the supplier, and some suppliers give you the cash discount. You will not deduct that. That is on the basis of payment, but this is on the basis of the number of quantity you are purchasing. So purchase price minus discount. Any import duties you will include. This will be included, right? Non-refundable tax also will be included. If this is refundable, then also you can't include that. Any non-refundable tax only you can include. Freight and transportation you will include, but only that's part of freight and transportation that is required to bring this inventory to our factory or to purchase the raw material when we are bringing it to our factory, not this cost which you are incurring at the time of sale, right? That will not be included. And the primary packaging, only the primary packaging will be included, not the secondary one, right? Primary packaging means the packaging which is necessary to put that. Suppose toothpaste, for toothpaste you have to, it should be in something like in a tube or something, that is primary packaging. It's necessary. If you are making it in the form of gift set and you are putting the tube, then that gift set kind of thing, that additional packaging, it will not be included, right? That will not be included. That is not under primary packaging. Next, cost of conversion. Cost of conversion will include your labor and factory overheads. Labor cost, the wages of the employees who are in the process of making this inventory. Admin salaries will not be included. This will be the labor cost only. Factory overhead, which can be variable, fixed overhead. Variable overhead, you can add on the basis of actual production unit. Like per unit, you will calculate and add on the basis of actual production. But for fixed overhead, that will be based on the normal capacity. Normal capacity means, suppose in a year you can 100 units, but that is the normal capacity considering all the scenarios. But due to any particular reason, so you can say abnormal reason, you are only able to produce 80 units. Then variable cost, so you will calculate per unit on the basis of 80 only and you will put it, right? But for fixed overhead per unit, you have to calculate 100 on the basis of 100. Like suppose annually fixed overhead, you have a fixed overhead cost, that is your rent of the premises, right? Sorry, rent of the premises, which is say 30,000 rupees. So how will you calculate per unit cost? You will not calculate on the basis of 80 units you actually produce, but you can produce 100, so you will calculate on the basis of 100. So what is per unit cost? Your per unit cost will be 300. Okay, you will calculate like that. Now 300 into 80 units. Inventory per unit wise. Then what will happen of the remaining 6,000? This 6,000 will go to P&L as a expense. You can expense of it in the P&L. Okay. So unallocated will go to P&L. Right. Any other cost which is necessary to bring the inventory to present location and condition specific to the inventory, you can include that cost in your cost of inventory. Sometimes you can include borrowing cost also, like you have borrowed and you are paying interest. What is usually the borrowing cost? It is interest. As per IAS 23, it says that some amount will be included in inventory, another will be in P&L. This we will see in IAS 23 only. After this index, we will cover IAS 23. Then IAS 41. We studied earlier that IAS 41, which is agriculture, says that till the point of harvest, it will be in IAS 41 and not in IAS 2, right? So, after the point of harvest, if you are in that business only, you are using it as an inventory, so obviously you have to put that in inventory. But what value you will take for that? You will take fair value less cost to sell, right? At the point of harvest, that will be included in the cost of inventory. Now, these some costs are to be included, but some cost we have to exclude from the cost of inventory. What is that? Abnormal wasted material. If there in the process there is a normal loss at 10% that we are any which ways we have to incur, that is in the process loss, then that you can include in inventory cost. But if that is something abnormal, like you have wasted a lot because your machine was not working or something happened or due to any mistake of the worker or something, then that will not be included in the cost of inventory. And the storage cost unless necessary in the production process. If that storage cost is necessary in the production process, that you will include. Otherwise, you will put that in P&L. You're just storing after the finished good is made. That you cost you will put in P&L. If that production process says before it's getting a finished product, then we have to put that cost into inventory cost. Say for few hours or one day, you have to keep it in a safe space on cold or cozy space. This is required for its production, then you have to, otherwise you will put that in P&L. This also you will put in P&L, this also you will put in P&L, which is not necessary in the production. Admin overhead in P&L, selling cost in P&L. Now we will see how we'll recognize the expense at the balance sheet date, that is subsequent recognition. So it will always be the lower of cost and NRV. Cost, as we discussed above, we discussed how to calculate the cost, but now we'll see how to calculate NRV. That is your net realizable value. So first of all, you will estimate what will be my selling price. There will be some expenses required to sell that product. You will deduct that selling cost, and you have to, if your product is not yet finished or something you have to do, you will deduct the estimated cost of completion. Estimated cost to sell, estimated selling from selling price we will reduce, and estimated cost of completion also we will reduce. Then you will get the NRV. Suppose you are getting your NRV is the 50, but your cost is USD 80. What you will recognize the lower of the two, that is 30. $30 is your loss, and you will not recognize it in the inventory. What you will do at the balance sheet date, you have to put this in P&L, and you can recognize your inventory at rupees 50 only. And if I'm putting my cost more, still I'm getting less for my product. What can be the reason? Like, it can happen. So if your inventory is in the nature of perishable goods, now it's not fresh, so it can't be sold at the correct, like actual selling price, or there is change in the market or consumer behavior, or some new technology is coming due to which your product is now not suitable or reduced usage, so you have to sell it at low selling price, because any which ways you will sell. This is also your sunk cost, because you have made the inventory already, so any which ways you will sell it, so you are selling it at a lower price, or the selling cost is increased in that market due to any reason, or the estimated cost of completion is increased because the product that you are using to make it, it's getting expensive. So any reason could be there, but you have fixed some selling price with the first party, but now you can't complete at that cost, your cost is more. So that also your NIV will be reduced only. You will recognize that this NIV only. You have to see at the balance sheet date. Or even before your balance sheet getting finalized, even checking after the balance sheet date, we will again study that in the respective standard. So the rest of amount you will expense in the PNL, which in our case is $30. So now, next we will see at what time we will expense the complete inventory in P&L. That is not just expensing of it is just booking profit. At the time of sale, what you will do? You will put it in P&L, you will remove that cost of inventory for your books. Right. So now there are few disclosures that are very important disclosures. We will study that. These disclosures you have to disclose in your balance sheet inventory note. It should disclose what accounting policy you have adopted. So you know there is a FIFO method, that is first in, first out. That is, you will calculate the cost of inventory, you are calculating on the basis of number of units which are left. You are assuming that the inventory that is coming first is getting sold first. remaining inventories, the last units only. So according to that cost, you will multiply the number of units. That is FIFO method. Another method is weighted average, in which you will just average out the cost of each unit. There is one more method which is last in first out, but that is not allowed now. And you will also disclose the carrying amount of inventory and amount of inventory recognized as an expense during the year. It can be due to the reason of sale, or your cost is more than your NRV. We will study the journal entries and example in the next class.